Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to the final Money Talk of the week on Friday the 12th of April. In just a moment, I'll have a summary for you of the latest business and finance news from across Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's consumer prices edged higher in March, but missed analysts' forecasts, underlying the challenges for the world's second largest economy as it tries to boost domestic demand. The country's consumer price index rose just 0.1% year-on-year in March, compared with economists' forecasts of 0.4%, and after a 0.7% rise in the prior month. The European Central Bank's Governing Council held interest rates steady at 4% for the fifth straight meeting on Thursday, but signalled a rate cut could be on the cards at the next meeting in June if policymakers were sure price pressures had stabilised. President Christine Lagarde told reporters that a small minority of policymakers had argued for an immediate cut. The PBOC signalled continued support for the currency after the offshore yuan weakened by the most in 3 weeks Wednesday following the US inflation surprise. It set its daily reference rate yesterday at 7.0968 per dollar, and the gap between the so-called fixing and economists' forecasts was the widest on record since Bloomberg started its daily survey in 2018. Spot Bitcoin exchange-traded funds could be launched in Hong Kong this month, with the first approvals likely to be announced next week, two people familiar with the matter told Reuters. That timeline would make Hong Kong Asia's first city to offer popular spot Bitcoin ETFs and is much faster than industry expectations of launches sometime later this year. Regulators have sped up the approval process, according to the Reuters report, as Hong Kong authorities have been keen to do what they can to improve the city's attractiveness for financial trading. On today's programme, I'm joined by Francis Lund, the CEO of Securities, and Frederick Chu, Managing Director at Magnum Research. With a view from Australia is Toby Lawson, the CEO of Statton Partners. And there are several ways you can get in touch. The best way is to go to my website, peterlewismoneytalk.substack.com, and while you're there, please take a look at my daily Asian newsletter. I'm also on Facebook. Peter Lewis Money Talk is the page, and on X, I'm at Money Talk R3.
Peter Lewis's Money Talk.
On Wall Street Thursday, stocks rallied after the latest wholesale inflation figures came in cooler than economists had expected. The S&P 500 gained 0.7% to close at 5,199. The Nasdaq Composite surged 1.7% to end the day at a new record high of 16,442. The Dow was the underperformer and slipped 2 points to 38,459. The moves reversed some of Wednesday's steep declines, which were sparked by an unexpected jump in consumer price inflation. The Dow's on pace to end the week lower by 1.1%. The S&P 500 is down just 0.1% week to date, and the tech-heavy Nasdaq is up 1.2% for the week. Shares of Apple jumped 4.3% after Bloomberg News reported that the company would transition its whole Mac product line to new artificial intelligence-focused chips. The iPhone maker registered its best day since May 2023. US Treasuries were mixed, with the short end outperforming. That means yields were lower. The yield on the 2-year notes dropped 2 basis points to 4.95%, and yields on benchmark 10-year Treasuries rose 4 basis points to 4.58%. The US dollar index held near 5-month highs above 105 on Thursday after rallying 1% in the previous session. The yen hovered near its lowest level since July 1990 at 153.25 per dollar. Gold jumped 1.9% to an all-time high of $2,375 an ounce. Brent crude oil futures settled down 0.8% at $89.74 a barrel, and Bitcoin jumped above $71,000 at one stage despite hot inflation data released Wednesday. At the end of the New York trading session, the cryptocurrency was up around 1% at $70,580. Hong Kong equities fell on Thursday, following stronger than expected US inflation that caused US stocks and treasuries to sell off. The Hang Seng Index shed 44 points, or 1/3% to 17,095, recovering from an opening decline of 1.7%. The real estate sector slumped on fears that interest rates will remain higher for longer. New World Developments dropped 4.3% and Shanghai properties slid 1.3%. The tech index was down 0.4%. On the mainland, the Shanghai Composite rose 0.2% to 3,034, recouping some losses from earlier in the week as softer than expected Chinese inflation data bolstered bets on further policy easing. And in Hong Kong this morning, looks like futures are going to open down about 1%, pointing to a start for the Hang Seng of 165 points lower, around about 16,930. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Friday morning guests, and we have back with us our regular Friday morning commentator, Francis Lund, the CEO of Securities. Nice to see you again, Francis.
Hi, good morning.
And also with us is Frederick Chu, who is Managing Director at Magnum Research. Morning to you, Frederick.
Good morning, gentlemen.
China's consumer prices edged higher in March, but they missed analyst forecasts, which underlies the challenges for China's economy as it tries to boost domestic demand. The consumer price index rose 0.1% year on year in March. That compares with economists' forecasts of 0.4% and a 0.7% rise in the previous month. A notable slowdown came after the effects of the Lunar New Year holiday waned, with non-food inflation easing. It was up 0.7% compared with 1.1% in February. Food prices in China declined by 2.7% from the prior year in March, much steeper than a 0.9% fall in the previous month. And this was the ninth straight month of declines in the cost of food. Pork prices fell 2.4%. That was a reversal from a 0.2% rise in February. Core consumer prices, which exclude food and energy, they increased by 0.6% year on year in March, slowing from the pace of 1.2%. Francis, I'm wondering what you make of this data. I mean, it seems the main reason for the miss was a moderation in non-food prices, but what does it tell us about China's economy and domestic demand?
Well, it says that the demand is still lacking. I think the problem remains that the Chinese consumer is not spending as much as the government wants to do them to. And people are still worried about the future. They don't know whether they can keep their job. So they are not spending. It's like Hong Kong. You see so many stores shutting down. And it says a lot about the optimism or the pessimism of the consumer for the future. People are worried about the job so that they are not spending as much. So it will take some coaching or some encouragement for the government to boost consumer demand, and it's a tough job to do.
And how big a problem is it? Because if you look over the past few months, the economy hasn't really moved away from deflation, has it? It's either been in deflation or close to it. And if you look at producer price index, that's been in deflation for something like 18 straight months now. So how big a problem is this?
Yeah, it's a great problem for the government policymakers, because when you have weak demand from overseas and also from domestic consumers, it's difficult for the economy to move to a growth stage. What we are doing is we are really not moving at all. People are just consuming what their daily needs, not much else. The government want them to buy cars, buy properties, and things like that. The problem is that the property sector have crashed. And with the property sector crash, it's difficult to boost consumer demand.
Frederick, you're on the mainland. What are you sensing from there, being on the ground, about China's economy and Chinese consumers?
Yeah, I think the situation hasn't really changed much for the past 12 months. If we look at the inflation for that period, I mean, it has been in positive, let's say 0.4, 0.3, 0.4 to negative 0.4, 0.5, somewhere around that, except for February, which is mainly boosted by the Chinese New Year. So I think the consumption power in China hasn't really gone up. But I think for the next couple of months, we can be a little bit optimistic for the April figures when it comes in with the Qingming festival, which has a 4 to 5 days consecutive holiday where the tourism has boosted up quite a bit. So I think the April numbers may improve a little bit. And May 1st, that's the Golden Week, which also have another, sort of a longer holiday break. And I expect, May 1st, the tourism, the consumption will pick up. Apparently, it's one of the biggest holiday in China. So I think the lucky thing is for April and May we have a relatively longer holiday break in the mainland that may help the figures. But from overall perspective, the actual situation of the economy has not really have any fundamental change.
It seems, doesn't it, that consumers only really want to spend when there's holidays. So they're spending on services, on travel, on cinema tickets, on restaurants and going out. But they're not buying things. They're not buying appliances or new cars. Is that a fair assessment?
Exactly. I mean, it's, going on, enjoying life. That's sort of like a work-life balance. And you have enjoyment in life, and at the same time, it's because the work schedule is less intense. I mean, employment has been difficult. It's way difficult to get a job in China than Hong Kong in comparison, for example. So, I think especially for young people, who's the the main drive of the spending, getting a job or keeping a job, it's not as easy as you think, and that hurts the spending power for sure.
Mm. So, Francis, what's to be done if we want to get people spending more? Maybe, there's a lot of savings, aren't there? I mean, the savings rate's about 45% on average, so plenty of money there. What can Beijing do to get people to spend it?
Well, I think on top of it, I think the most important thing is jobs. If young people have jobs and they have job security, they will spend. They will form families and things like that. Mm. So maybe. Communists always call for a welfare society, let everybody have jobs. Are we going backwards to the good old days? I don't know. But if they really want to boost the economy, they can try a state sector job creation and employ all the fresh graduates. And that will create a lot of demand. But I doubt the government will do something like that.
And the problem is we don't really have the data, do we, on the state of the employment markets. Because a lot of migrant workers get left out of the figures. The youth, they stop publishing the youth unemployment dates. We really just don't know, do we, what's happening in the employment markets anymore, in the jobs markets.
Yeah, I think that one thing is certain, that every year China is adding 40 million fresh graduates, and they all need a job. And from what we heard, that many are not getting a job offer. I think that is really the crux of the problem. When the economy stops growing, it stops creating jobs for the young people. That is the biggest problem for the Chinese government right now.
So, Frederick, do you see this as being the solution for the economy? Jobs, more jobs? What the government should really focus on is job creation?
Yeah, that would obviously be one of the mainstream solution. I think the other thing on the spending power is with luxury product, which was supposedly targeting on the wealthier class. I mean, the problem is more on the political front, where the wealthy people they are very cautious in terms of showing off their wealth in the society, or where they want to avoid buying luxury cars, buying luxury products that could causes attention from the government. I mean, some of the action taken by the government, it's really to look into the wealth of these people and see whether they have taxation problem, whether they have some other problems. So I think the overall environment, the atmosphere, it's like if you are rich people, then please try not to show that you are rich. So that means a lot of things, right? So I mean, if you see the electric cars from Xiaomi, yeah, it's a long lineup of subscription, but that doesn't really represent a major portion of the wealthy people. So I think that would be another problem, which to me I don't think it's easily solvable.
We're seeing, aren't we, Francis, that in some areas where people are, maybe interested in buying, like electric vehicles, there's a huge deflation going on there because price cuts are just absolutely savage at the moment.
Yeah, I think the rise of electric cars in China is really a great threat to the auto industry in the world for countries like Germany, Japan, and the U.S. Auto industry forms a big chunk, a percentage of the industrial base. If cheap Chinese electric cars were to flood the world, and many of these auto manufacturers cannot survive, that will really destroy the industrial base. That is why Treasury Secretary Yellen is coming to China to try to explain to China that please hold off your cheap electric cars, otherwise our car industries cannot survive. And that is the message that Yellen tried to deliver to the Chinese government. And I think...
Do you think that message was understood?
I think the message was understood, but how can you keep a cheap product from the consumer? The consumer needs it. That is the problem. That is the problem Chinese manufacturers created for the industrial West.
So, but the problem is, if you're the consumer, it's great if you get these cheap goods, but not so good if you're working in manufacturing or one of these sectors and then lose your job. Yeah,
that's right. It's good for a service country like Hong Kong. We don't have a manufacturing base, but it's not good for a city like Detroit, which depends on the car industry, or Munich, which depends on BMW.
So what do you make of these working groups then that were set up to talk about balanced economic growth? Do you think they're going to get anywhere?
Well, you see, they're all based on self-interest. The U.S. want to stop Chinese growth in the high-tech industry, but want to stop import of cheap industrial goods. How can China accept that? No Chinese government will accept that. That is a big problem.
This is the problem, Frederick, isn't it? I don't think the Chinese government is going to be told by Westerners or Western organisations how to run their economy. So I'm wondering just how these talks are really going to progress.
I mean, I don't see a particular light on this. I mean, it's clearly the world is going from globalization to protectionism. The automotive industry in the West, it has been a glory, but now it's basically quite outdated in terms of what they offer and what they align with the market. For the Chinese, for the EVs, I think that's two sides of coins. Either it's being demanded by the global world, which, in terms of the car itself or the main parts, for instance, and that will help drive up the EV industry. And whereas the Western world can also build up their own EV franchise with the help from the Chinese. I think that's a win-win situation. But then if the protectionism goes on, which means that I'm trying to stop your EVs coming out into the Western country, then that would mean either the Germans or the Americans, they build up their own EV capability, which sells at pretty much same level as what the Chinese firm can sell, which I don't think that's easily achieved. But then irrationally, which is what the world has the politics has been going on at the moment. I think if that's the way they take, then it's going to be long lasting from a political angle.
But what Janet Yellen will say, or what she is saying, is that, look, it's not that we want to stop Chinese electric vehicles coming into our market. It's that we don't want to be swamped by electric vehicles that are being sold below cost because of all the subsidies that they're receiving from the government. And while there is demand, at the moment, that demand is just being overwhelmed by the supply.
Well, everything needs a reason. So I think overcapacity is a reason they use. Whether or not it's really below cost, I don't think Yellen can see through, the balance sheet of each of the the cost income ratio of each of the manufacturer. I mean, you have the intelligence, but you may not have the transparency. So we take it as it is. I mean. Like I said, everything needs a reason for accusation. I mean, even though it's cheaper relative to any EV cars that could make out of the US, that's very natural. I mean, we have cheaper labor, cheaper everything, raw material and everything as compared to the US. So I don't think it's fairly it's a fair judgment to put it on the same ground, but. Like I said, it really depends on how much. I think the best bet would probably be, instead of exporting your cars to the US, for instance, probably some of the major parts in exchange of chips, for instance, that could probably work out. But we'll see how it goes.
Francis, what about then interest rate cuts? If we want to boost demand and if we want to get the economy out of deflation, the normal way to do it is to cut interest rates.
Cutting interest rate, it may work the first time, but the second and the third time, it may not work at all. I think theoretically, if you cut interest rate, especially mortgage rate, you will boost demand for properties. But the problem for prospective property buyers is that they're afraid that property prices will fall even further. Mm-hmm. And so people will stop buying properties. I think the government must do something to really stop the property prices from spiraling down so much. I think that is really one of the major causes for the economic doldrums that we are seeing right now is really the government's inaction to really salvage, to support the property market. I think the government certainly should and could do much more. Short of saving these crashing property developers. I don't think the government should save the developers, but certainly the government should really support property prices, stop them from falling even further. I think that will do much more than cutting interest rates. I think interest rates are already quite low now. It won't. It just won't work even if you cut it further.
But isn't the government behaving like King Canute here? Property prices need to fall further. They still haven't reached their real clearing level, given the massive oversupply on the mainland. The part of the problem, isn't it, is that the government won't let the market find its natural level because it is afraid, as you say, it's going to be a lot lower.
Yeah, I think so. Well, according to some estimates, China has 6 years supply of flats unsold. So if you stop building for 6 years, you will still have enough flats to go around to house everyone. I think the government must come up with some working policy to really solve this problem. I think that I think actually currently the developers are not building too many new flats. That is really the right direction to reduce supply first.
Frederick, we're in an interesting situation here, aren't we? Because we've got rates coming down in China, or need to come down, rates not coming down in the US, and maybe even have to go up. That's going to widen even more the yield gap between China's rates and the US rates, and presumably put more pressure on the yuan, which is maybe one of the reasons why the government doesn't want to cut interest rates.
Yeah, exactly. And I pretty much agree with Francis that, cutting any rates further, it's not really going to make any difference. I think when the overall perception of the domestic people is try not to stay your wealth within the domestic environment, cutting more rates is just going to encourage them to find ways to diversify. So I think the negative effect could also be there alongside with, obviously there will be positive effects that some sort of picked up in the spending, but the negativity also comes along. And for the property price, I have a sense that it's not in the interest of the government to accelerate the property growth market like the way before. They rather want to keep it in the stable, lower, sort of like a level. I mean, it's that is the employment rate and the labor market, the spending, etc. If you look at for the young people. For instance, in Shenzhen, for instance, a youngster which major in IT, for instance, which is major industry in Shenzhen, it's probably the monthly salary is probably about 10,000 RMB. And if you want to pick because most of them are not really local Shenzhen people, so if you want to pick a house, they live in Shenzhen by themselves. So if you want to pick a house in Shenzhen, an apartment closer to your office around Futian, for instance, it's going to take up at least 30% of their monthly salary. So it's not like before. It's 1,000, 2,000. You can pretty much have a smaller flat. It's no more like that. So I think if the price keeps going up with the rental market also goes up alongside, and that could cause a bigger problem.
It's interesting, isn't it? Because, there's a big contrast now between Hong Kong and Shenzhen in terms of costs, in terms of salaries, this vast differential, which is causing Hong Kong people to flood over the border every weekend to Shenzhen to spend money where things are much cheaper. And, of course, Chinese people don't want to come to Hong Kong because it's way too expensive. Something's got to give somewhere, hasn't it?
Yeah, so I think a relatively weaker yuan at this point of time is in the interest of the government, and of course also in the interest of consumer like us when we going spending in Shenzhen during weekends. It's in favor of many Hong Kong people now. That's part of the reason.
So, Francis, what's to be done on the interest rate side? Because the PBOC was sending out quite a strong signal yesterday, wasn't it? That it's not prepared to let the yuan slide at the moment. Although presumably a weak yuan would be quite good for the Chinese economy at the moment, but they don't seem to want to let that happen.
Yeah, I think, actually, a weak yuan is good for the manufacturing sector because it makes Chinese goods cheaper and makes the Chinese export more competitive. But then the other problem comes around is that external demand, meaning exports, are not really going that strong. The only bright spot we see is really electrical vehicles, EV, which is causing problem for the Western countries. And well, it is difficult to be a policymaker because in terms of interest rate and industrial policy, you are very you cannot take active action and expect to produce a result right away. It a lot depends on other people. So I think the Chinese government will just have to wait and see if this low interest rate environment and cheap yuan can create a boom in Chinese exports.
Frederick, let me ask you about the Fitch downgrade. Fitch cut the outlook on China's long-term foreign debt to negative from stable, basically citing increasing risks to the country's public finance prospects because of fiscal policy. Obviously, this isn't an actual ratings downgrade. It's a cut in the outlook, although they do often lead eventually, don't they, to a ratings downgrade. But how significant is this, if at all?
I don't think it's very significant in terms of what the Fitch has put up. I mean, back in as far as I remember, 2012 or 13, it has it's picked up the rating accordingly, but it doesn't really do any big difference. So I mean China at the moment, it's pretty much going on a internal circulation of their fiscal policy. I don't see a particular upside or downside of this, but it certainly describes what the global market is looking at China from a longer term perspective, but I don't see a substantial or solid impact onto the nation.
Francis, what do you think? Any impact on the markets at all from the Fitch outlook change?
Not really, because the rating agencies' comments are really what everybody knew already for quite some time, that Chinese economic growth is hitting a roadblock, and it went from 10% to 8% to 5%. Maybe we're not going at all. I think that is the problem. The problem for the economy to grow from a relatively undeveloped country to a mid-level country, and unless China can upgrade its manufacturing sector, I think it may be stuck at this mid-level for quite some time. And this is a natural stage in economic development.
Let me ask you before we finish about the markets, the local markets here in Hong Kong and on the mainland. Obviously, a big impact wasn't there from the inflation data from the US earlier in the week, which makes it look more and more likely that maybe we're not going to see any rate cuts this year in the US. Now, that, I presume, is the last thing Hong Kong needs at the moment. It really needs to see some rate cuts, doesn't it? So what's the impact going to be on the markets?
Well, I think that this week we see some impact already. I think the market fell sharply yesterday. But then I think the market's really more interested in what Jack Ma Yun has to say. And Ma Yun said something positive about his company. And then the Hang Seng Index saw 300 points on Wednesday. So I think what we need is really more good news from these big techs like from Alibaba and Tencent and maybe Meituan. So I think if they do well, I think Hong Kong market will do well.
So it's going to come down to the individual companies, the earnings reports, and as you say, good news about the prospects rather than the economics.
That's right.
Frederick, what are your thoughts about the markets?
I think the Hang Seng Index has been picking up quite well. It seems like the bottom has we've seen the bottom for the time being. But I think whether or not it's going to sustain, it's still really very, very much depending on how the interest rate goes. Even though the U.S. inflation seems to be resilient and also the labor market is still strong, but I do not rule out the chance of an interest rate cut cycle coming in the middle of this year. Because the PPI is certainly cooling down if you look at the year-on-year figures. So I think it's just we shouldn't be too optimistic over 1% or more rate cut this year, but controlling the inflation it really is a timely matter. It really takes time. So I think the next couple of months we will probably see something different.
The problem is, if you aggregate out the data over the last few months, it clearly shows that inflation in the US has stalled around 3%, hasn't it? It's not coming down to that 2% target. So either the Fed's got to give up on that 2% target, in which case it'll lose credibility, or it's got to hold off on the rate cuts and say we're just not ready yet for rate cuts. Yeah,
it's not coming down as quickly as the Fed wants. But then it's not going up neither. If you look at the PCE figures just released a couple of weeks ago. So my take is it takes longer time because the labor market is intense. It's difficult to hire people, and you need to pay more to hire people, which also the income part really drives up the spending and so forth.
Okay, well, great. Thank you very much indeed. Have a great weekend. You heard there Frederick Chu, who is Managing Director at Magnum Research, Francis Lun, who is the CEO of GEO Securities. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Hey, good morning, Peter.
We had a bit of an inflation shock this week, didn't we, out of the US? Consumer prices rose 3.5% over the 12 months to March. That's up from 3.2% in February. Do you think people are maybe overreacting, or are there some genuine reasons now to be concerned that perhaps inflation has stalled out?
Well, I think we've been discussing it over the months previous that I think the Fed would like to hold on as long as they could to ensure that inflation doesn't get entrenched and that it continues to decline. So the figures during the week were particularly reactive because of the fact that it pretty much entrenches the view that any June rate cuts out of the question. July is probably out of the question. It's more likely September. What was interesting, and I read through this was an article I picked up from somewhere else, that if you did what they call super core inflation, so core inflation is ex food, energy, shelter, and rent. If you take out shelter and rent as well as food and energy, the 3-month increase in the CPI is close to 8%.
Huge.
So it's actually really spiked. Yeah, it's been a high move, highest in 11 months. And I think if you look through the numbers, the services inflation continues to be really sticky. So I think, I don't think the reaction's an overreaction. I think it's an affirmation that, we've got a fair bit of ground to cover before we see that first cut.
So this is a problem, isn't it? Because those things that are particularly sticky are the sort of things that the consumer can't get around. It's like shelter costs, property taxes, home insurance, all those types of things which people have no choice but to go and do. So it's going to be really hard, isn't it, to get this much lower at the moment?
I agree. I think it's as you quite rightly point out, these are not discretionary expenditure for consumers that they can wind back. they're going to continue to pay for them. So it does feed straight through to not only higher prices, but also consumer expectations. And we always talk about inflation not being an actual measure of actual prices. Often it's actually, the most important thing about inflation is the expectation of prices. And that feeds through to producers being able to pass prices through because consumers expect it, and also the capacity for consumers to be able to change behaviours around prices, which in the case of some of these costs in the services sector, just they can't avoid. So it gets getting tricky.
So what does the Fed do if these prices, and if you look back over the last few months, it's very clear that inflation is not coming down to 2%. It's sort of stuck at just above 3%, isn't it? So what does the Fed do? Does it have to consider maybe raising rates?
Yeah, I think it's premature to suggest a raise of rates, but I don't think it's out of the question. Certainly the language wouldn't suggest that. I think one of the Fed governors last night, John Williams, indicated that, there's no rate cuts for now, but there's certainly been no pivot back towards higher funding costs. You got to remember there's also that other aspect of the equation is the quantitative tightening and the that happened with the bond market and treasuries. They can probably loosen policy a little bit through that mechanism at some stage, although I was seeing last night the fiscal deficit is huge and the interest cost on that means that, if they continue to open the spigots there, it's going to be no good for inflation. So, they're in a pretty tight spot, I think. There is some volatility to the series, so let's not look at 1 month and say it's all over and things have changed. But if we see another month where we see a bit of entrenchment at this sort of 3.5 level, then maybe the conversation switches to higher rates, not lower rates.
The thing is, the Fed's running out of time, isn't it, if it wants to cut rates this year, because it is now looks like, if you look at the markets anyway, they've pushed out the first cut till September. So we're getting close to the end of the year. And of course, the election in November. There's not much time left for the Fed to move now if it really wants to cut rates this year. And certainly the 3 times it was saying in the dot plot.
Yeah, so what will be interesting is, do they shift that dot plot out beyond the election? That's quite possible now because obviously they really want to avoid doing anything around the election, albeit they should be independent in their thought and their action. So September, if it's the 1st, it doesn't leave, then you've got October. It means so maybe, it's December's for the 3rd if they're even in that space. So I guess the next month, the June data, May, June coming through this quarter will be most significant for that assessment.
It's interesting, isn't it, the disconnect at the moment between Jerome Powell and what some of the other members of the FOMC is saying. Jerome Powell's been quite dovish, hasn't he? He's sort of saying, yes, we're in a good place monetary policy-wise, inflation's coming down, but we just want to make sure that it does get down to 2%. But now you've got other members on the FOMC, like Neil Kashkari, Michelle Bowman, saying, no, I don't see anything more than maybe 1 cut at the most this year, if at all. It's just too early to be cutting rates. So there's this sort of disconnect now between what the Fed chairman is saying and what some of his other members are saying.
Yeah, and I think that's not unusual. That happens from time to time, particularly when we're in a sort of a pivot scenario where the Fed have indicated that they will pivot on rates to a lower trajectory, and essentially, they're not saying that that's not going to happen. A lot of these other governors, they're just saying it's going to be delayed or it may not happen as quickly as people think. So I suspect that at the margin, there's not a huge amount of disparity, and I suspect Powell will either clarify pre-next meeting or in the post-meeting conference where they stand as a central bank. And to be honest, the market will take lead on what he says more so than what other governors say, even if they're slightly non-aligned.
So how do the markets react to this? How do investors play this? Because we've got 2-year Treasury yields now at 5%. We've got the 10-year at 4.6%. There's been a big spike up, hasn't it? Which initially looked like it might be a headwind to stocks. But then today we get the Nasdaq at a new record high. So what are investors supposed to do?
Well, I think it's, asset allocation should be, they could probably take a little bit of a little bit more weighting towards fixed income, and duration is not necessarily a big issue right now, and you could probably start to pin it a little bit more in that sector or other defensive assets in the equity market. I suspect probably the equity market will underperform if we continue to see bond yields up, particularly over 4.5%. If they head towards 5% on the 10-year, that should have a downward pressure on equity. So I guess asset allocation towards some of the defensive sectors and potentially into fixed income gives investors a bit more comfort that they can ride out any of that volatility.
And what about the ECB? They met yesterday, left rates on hold at a record high of 4%. Are they in a very different place from the Fed?
Well, that's what Christine Lagarde was quite keen to attest in her press conference, that there's no correlation between where the Fed is at and where the ECB are at least from that perspective. They see a gradual improvement. The word gradual was used quite often in the text. The economy still remains weak. There's a gradual recovery. There's a gradual decline in inflation pressures. There is disinflation coming through. They want to see more data by June, and they think the reduction in inflation is happening, but it will be bumpy. So all of that is not inconsistent in terms of language, but in terms of timing, I don't think there's a lot of correlation between where the Fed is at and where the ECB are at. I think the economy is certainly a lot weaker in Europe than it is in the US.
I mean, yeah, that's true, isn't it? And also she's hiked policy further into restrictive territory as well than maybe the Fed has.
Yeah, that's true.
I'm wondering, though, how far she can go with that argument that, she's data dependent but not Fed dependent, so that even if the ECB does cut first, I'm wondering, it's going to be hard, isn't it, for them to continue cutting if the Fed doesn't. If the Fed delays rate cuts, it's going to be quite difficult for them to go too much further.
Yeah, I think I'm not sure that they would look at that specifically as a reason not to or to hold off. It certainly becomes a factor. And I suspect central banks do a little bit of coordinating more and more. So, but I would suspect the ECB will run independently as to what it feels is necessary for their union. And as I say, the different dynamic is the economy over there is much weaker than it is in the US. Mm-hmm. So they might not be able to wait to the same extent where the Fed, really probably has a bit more time up its sleeve because the economy's still performing pretty well.
And what about in Australia? What's the inflation picture looking like down there?
So much the same language, although I think our central bank tend to be a little bit more hawkish. And I don't say hawkish as in they want to tight, but very much about saying that it could go either way on rates. So as opposed to switching to a dovish stance, our central bank's been pretty clear to say, they're not out of the woods. So we have the same issues in relation to stickiness around the services sector. The labour market's still reasonably tight. The housing sector is still pumping, and that is driven a lot by the increase in migration and the undersupply of housing. So there's some structural elements that are keeping prices high, and I think it's making the Reserve Bank nervous. As well, we have productivity issues, and they're the things that are probably leaning our central bank to keep a foot on inflation a bit longer. And of course, we're running at about, we're slightly under in terms of relative tightening that happened relative to the US. So we've still got a little bit of, a little bit different in terms of headline interest rates.
Now, on a slightly different topic, Australia's going to overhaul its mergers regime to try and guard against anti-competitive deals and hand more power to the country's competition watchdog. What's prompted that?
Well, you've got a government that probably errs on the side of protectionist policies. There seems to be a new dynamic around reshoring. Is that an expression they use around the world now? One's to do with supply chain security, trying to build capacity onshore rather than offshore. That's a dynamic that's existing around the world, and this is sort of part of that story, where Australia doesn't produce a lot, and so the government's trying to do two things. One, in terms of competition, is trying to ensure that local producers and local players are not swamped by big globals who can come in with pricing power. So there's one aspect, that's the ACCC side. And then the other aspect is the push by the government to promote a made in Australia across some key sectors. where, we feel that we can build some manufacturing capacity and do that through subsidies and through protectionist policies. So there's certainly a shift, and this is not inconsistent with the labour market, labour government, which, is probably errs on the side of intervention in the economy versus free market.
Has there been concern that maybe, the regulator just doesn't scrutinise enough deals and there are maybe too many anti-competitive mergers going on? Is that maybe part of it?
Yeah, I think the unintended consequence is always, it's on the one thing to protect smaller players, but if you create a level of complexity around enforcing that, it can actually be costly and therefore inefficient. And the other aspect, which has been quite clear in Australia, that if we are not competitive, we don't have the scale to be able to support industries that are not competitive on a global level. And so the worrying thing here is that, yes, let's say the idea of it and the rationale behind it can be considered sound, but the reality is, as we saw in our motor vehicle sector, we are not capable of competing with global manufacturers for motor vehicles, for instance, and we're unlikely to be able to do it when it comes to solar panels or other bits of technology that we can't produce at scale.
Yeah, I find it interesting because the Treasurer, Jim Chalmers, is quite an activist treasurer in the sense that he's shaking up quite a lot of the ways in which Australian financial institutions work, isn't he? I mean, there was not only this, but also a big shake-up of the way the central bank operates as well. He seems to be, determined to try and create quite a modern sort of operating environment for the financial sector.
Yeah, and one which has government at the centre much more. In terms of it's much more an interventionist, which is consistent with the ideology of the party, and certainly feel that government plays a key role in determining policy, but also implementation and also contribution to these within the economy. So it'll be an interesting aspect. I think if you're a free marketeer, you'd probably be slightly concerned, but there are elements to good rationale to help local producers and local competitors be able to maintain their position in the market.
Toby, it's always a pleasure. Have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which as always is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Michelle Lamb, Greater China Economist at Societe Generale Corporate and Investment Banking. And providing a view from mainland China will be Shanghai-based independent economist Andy Sher. Have a great weekend.
Money Talk.